Good afternoon. This is Chris Bolter and Jeff Lamont. Thank you for joining us here this afternoon. We're going to give this about 2 or 3 minutes before we kick off, as we know not everybody is as prompt as those of you in attendance right now. All right, Jeff, you ready?
Ready, let's do it.
All right. So thank you again, everybody, for joining us here today. We're here to talk about our loan programs, to give you a better idea as to the types of loans we originate. And we're also here to introduce a new product that we shared in our invite that we call our deferred interest loan, oftentimes called straight note, a loan with no payments, that we think might be a way of expanding your product line. This is just a quick outline as to what the program is going to be about today. We're going to try to keep it brief and hopefully provide a significant amount of time for any Q&A. So let us start with a little bit about us and Val-Chris Investments background. We were formed in 1975. I've been the broker here since 1986. We are a private money lender, and this is all that we do. We don't do any other types of lending. We don't originate non-QM. We never did subprime back in the subprime days. All of our loans are funded with our own money, so we don't need to worry about secondary investors. We sell the loans off after we fund them. The underwriting is all done in-house. Either myself or Jeff make all the underwriting decisions. That provides a quick manner to get your loans approved and hopefully get them to docs as quick as possible. As we shared here too, one underwriting for pricing rather than a committee means when we give you that pricing, you can rely upon that, and so can your borrower. We're not worrying about whether or not somebody else may decide to change the pricing at the very last minute. So let's go over the types of loans that we do. All of our loans, or at least the vast majority of them, other than true bridge loans, have to be primarily for a business or investment purpose. We define that as 51% or more of the loan amount needs to be for a business or investment purpose. And that can be secured by an owner-occupied or a non-owner-occupied property. We do first trust deeds or mortgages in other states, and we also do the second and third trust deeds and mortgages in many states, California being our primary. We do owner-occupied refinances, as long as the money's being used primarily for a business or investment purpose. Perfect example is somebody who's starting a new business or wants to expand their business, doesn't own any investment property, but has significant equity in the residence. We're happy to make that type of loan. Purchase money is a little bit different. If it's going to be owner occupied, the only way we can help you with that is if it's being purchased in an existing LLC or corporation, typically one that is already generating income, already has a bank account. Then we can do an owner occupied, but it has to be in one of those entities so that it's not going to be defined as a consumer purpose loan. All of our loans are stated income, stated assets. I oftentimes get inquiries from brokers asking if we do a DSCR loan. We don't have any DSCR requirements. We don't have any DTI requirements. Again, our loans are stated income, stated asset. We don't require W-2s. We don't require bank statements. We don't require tax returns. Credit scores, we don't have any minimum credit scores. We also make loans to foreign nationals who have no credit. So there is no minimum credit score, although your borrowers will get a better rate typically if the credit is a little bit higher than if it's lower. We also put in here too, we can close on a short sale, REO transactions. Borrowers can even be in bankruptcy as long as we can get a court order allowing us to do the refinance to take them out of bankruptcy.
Really quick too, Chris, one thing I want to add, anyone who might have questions from the seminar itself or from what we're putting on, go ahead and use the Q&A box down below, and then we'll go ahead and get to them at the end of this as well.
Thanks, Jeff.
Yep.
We put this in here too. This is just a quick outline. It includes the 9 states that we lend in, and it gives you a quick outline. And I just noticed we have a typo on property type. We're missing an R on the property, so please excuse us. But everything else looks good here. It tells you what we do in each of those particular 9 states. So you do see that we offer junior mortgages. We call them trustees here. Also in Arizona, in Colorado, and Nevada, besides California. So this will be a good outline and something for you to keep when you're about to submit a loan to us, wondering whether or not we loan in those particular states. Also to keep in mind, you'll notice that in the states of Arizona and Nevada, you need to have a broker's license, or at least the person being paid needs to have a broker's license for us to be able to fund that loan.
Yeah, a couple things for me too. So on this, so when it comes to the licensing, like Chris mentioned, it's not a Department of Real Estate brokerage. It's a mortgage broker, mortgage banker license from that state, DFPI licensed. I often get asked if the Department of Real Estate license, DRE in those states work. They do not for this type of lending. So it needs to be DFPI. Also the loan values, it says maximum loan to value. That is the maximum in those states. Not all transactions may qualify for that level. So just submit it and we look at it as a deal by deal basis.
Thank you, Jeff. Let's go to the next one. Okay, the types of products we offer. As shared initially, we do first, second, and third position loans. In California, we call them trust deeds. Other states, they might be called mortgages. We do cross-collateralized loans. We see this oftentimes in bridge loans, but in other cases where there's not enough equity in the subject property and the borrower owns other properties, we can use that as a method of extending the size of the loan or the cash out. True bridge loans, that's the only consumer purpose loan that we originate. We have an exemption from many of the ability to repay requirements that fall under a true bridge loan. And that's when a borrower is selling their primary home. They don't have time to sell that particular home. They need the cash out to close on a new owner-occupied purchase. We are getting a lot of requests for those, and we're happy to do those. We loan to foreign nationals. We do loans in probate. I'll also add in there what's already on there. We do loans with properties that are in bankruptcy. The key with probate is that the property should be, in most cases, non-owner occupied. Otherwise, it may be considered a consumer loan. So keep that in mind on probate. We've shared with you, we do a lot of purchase money. If it's going to be owner occupied, don't forget that it should be, they should be taking title in the name of an existing and cash flowing LLC and corporation. Refinances, they can be rate and term if the loan we're paying off was primarily your business or investment purpose loan. Otherwise, of course, they can be cash out loans. We also loan on mobile homes and manufactured homes as long as they own the land. The one thing I didn't mention in here, we also do loans on long-term leasehold. We see that most commonly, we see that in Palm Springs. We're seeing that on some of the condominiums we're doing in Hawaii as well. So there may be some cases where they're on long-term ground leases. We may be able to help you there. The types of property we've listed here: residential, commercial, industrial land, and multi-unit property. So we do just about everything other than construction loans. Ready for the next one?
While we're moving slides to mobile and manufactured must be affixed to the foundation. So it needs to be assessed as real property, not something that you can move.
Okay, just a quick, we just want to go over some of the questions for you brokers who haven't closed with us. Some of the questions we get again is, how do you get paid? All of our fees are going to be disclosed to the borrower. We're acting as a lender on all of these transactions. Your fee will show up as a broker fee. Our typical guideline is you can charge whatever fees you choose to charge as long as your fees don't exceed ours. and they'll be fully disclosed to your borrower. You never have to guess what you're making on a loan. It'll be something we put in writing for you, so you typically don't have to worry about that, and it'll be paid at the closing. Our typical fees range in most cases from 1 to 3 points, unless the loan is incredibly small, and you're welcome to match our fees, or of course charge less. On the what to expect after submitting your loan, we shoot for 10 business days. A lot of that depends on how quickly you can get us a complete package. You'll find our submission packages can be used on every single loan. You don't need a different package. So if you save it, we don't typically update it more than once a year, so it should be good for you. And we find it to be relatively easy if you'll take a few minutes and fill in all the blanks. When you submit a loan to us, we don't communicate with the borrower. You're the borrower's agent. So we expect to be able to reach you and have you handle any conditions we have. We protect you as a broker. Once you've submitted the deal, we lock you in as the broker. So if the borrower decides to go around and shop and comes back to us directly or through another source, you're going to be protected. They're going to have to do the deal through you. Honest and competitive pricing. Jeff and I underwriting the loans. We give the pricing to our account executives. These are terms we know that you can rely upon. In cases where a deal might be competitive, we're pricing with somebody else, you can let your account executive know. If there's some room for negotiation, we'll do our best. Years of experience. As we shared, we started in 1975. So I've been the broker since 1986. So we're one of the oldest private money lenders with our vast experience. We've also got a large staff of people who've been with us for a significant amount of time. We think you'll be able to rely upon us and what we share with you in pricing and loan terms. All right, next slide. Okay, let's get on to our new product. And that's what some of you are here all about. And that's our deferred interest loan. Jeff and I were talking about ways of generating new loans, and we realized that one of the best ways we could do that right now and make ourselves more available to borrowers out there is to provide a product that didn't require the borrower to make payments. And this is what we're offering right now. We call that our deferred interest loan. We hope that this will start with allowing you to increase your pipeline. When you can go out to a borrower who may be a little bit averse to a high interest rate, a way for you to market it on those loans with good equity is the fact that they don't have to make payments. So that might be something that will allow you to be able to handle the higher rates that private money loans typically have with that particular product. Capturing new segments. This is an ideal loan for people, again, who are self-employed, people who are investors, who need that cash flow right now, and the ability to be able to defer those payments is going to allow them to complete possibly the development of an investment property, maybe an REO that they've taken back and they need to rehab, or for other projects where that cash flow right now is going to help them reach their end game quicker and more efficiently. Standing out in the market, we want to be able to separate you from some of the other brokerage companies out there by offering this as another private money product. We're unaware of any other private money lenders in California, at least, that offer this. So we hope to be able to set ourselves aside and allow you to set yourself aside as well. Going over the loan terms, this is not going to be designed as a long-term private money loan, largely because it's a neg-am loan. Most of them are going to be written at 1 to 2 year terms. If the equity is significant, we'll consider going up to 3 years. Highly unlikely we'll do a loan for more than 3 years. Again, trusted backing. You're dealing with a private money lender in Val-Chris Investments who's been around. Jeff's been working very diligently to make sure we've got our software in place for loan origination of this product. And we anticipate in the next few days, we'll be notifying everybody we're ready to start accepting your loan submissions. Okay, so when you're selling this loan to your borrower, because you've got to be able to share benefits to any borrower in any of your loan inquiries. First and foremost is cash flow optimization. By the borrower not having to make their monthly payments, it's going to allow them to be able to use that cash for their business product, their business development, for their rehab, or for other purposes. So for those borrowers who are concerned about the cash flow and having to debt service it when they need the money for their investment or for their business opportunity, that'll be first and foremost. Flexible repayment timing. There's no payments on the loan. so they don't have to worry about that. So for those particular clients who need the liquidity right now, but are expecting that they were going to use another method to pay the loan off, for instance, the sale of the property, possibly they've got an inheritance coming in 12 to 24 months. That's their method of payment. Or, and we've mentioned here another possibility is somebody's going to get a distribution from retirement as their means of repayment. These are other ways that this loan might be a benefit, and they don't have to rely specifically on a refinance. Potential tax benefits. We're not going to touch much about tax benefits, but there may be some of your clients who may want to defer that interest deduction to a later time. So rather than taking the interest deduction, say in 2025, it may behoove them to take it in 2026. There may be other gains that they anticipate getting in the next year or 2 years down the road. And by deferring this interest and paying that interest at a later time, they may find there's some benefits for doing that. Certainly, Jeff and I are not CPAs, so you need to have them consult with their tax advisor, but there may be some benefits for them in that particular space. Administrative simplicity. There's no ongoing monthly servicing. There's no payments. They're not going to hear from us after closing until we get 90 to 120 days out to their balloon payment being due. So other than you possibly keeping in touch with them as to assisting them in their refinance, they're not going to have any administrative duties to us. So it's going to be a very easy process for them and for us. Streamlining process versus alternatives. There may be clients out there, for those particular clients who may be looking at a reverse mortgage who are not retired and are not taking out a reverse mortgage to meet their consumer needs, but may be looking at a reverse mortgage to pull out money out of their home that may be equity rich, specifically to expand their business or to buy investment properties. This might be an alternative. Jeff and I don't originate reverse mortgages, but I understand in some cases they can be pretty expensive. Our rate might be slightly higher, but I understand sometimes these fees can be 4 to 5 points on a reverse mortgage. And I also understand they can take a very long period of time. So this may give you a product for those clients who are using the money primarily for a business or investment purpose, offer them an option to a reverse mortgage. I missed one there. Can we go back one slide? Yeah, preservation of equity avoids getting into equity sharing arrangements. We've seen a lot of loans in the last couple of years where homeowners have used the equity share product out there as a means of being able to pull cash out of their property without having to make payments. Those particular arrangements can be extremely costly for a borrower when their home's appreciated. This might be a better option. So please keep that in mind if your clients are considering an equity share. Might be better to protect your equity, not give that away, and take this loan out instead. Loan to value structures, primarily as we shared, these will be 1 to 3 year loans. We're going to focus primarily on 24-month loans. Depending on the equity, again, that'll have some bearing on the loan term and what your client wants. You're going to find the loan to values are going to be slightly lower. We're going to focus primarily at 55% as our max loan to value on first and 50% on seconds, or in those cases, possibly thirds. The product will have no payments. So whether it's a 12-month, 24-month, or 36-month loan, there will be no payments until the loan has matured. We will not accept partial payments. We will only accept a full payoff. So your client will not be allowed to make a partial payment if they take this product. Their only option will be to pay the loan off. Once it's gone past the prepayment period, they can pay it off at any time without any additional costs or fees. Interest rates. The one thing that you want to share here is that the interest rates will likely be 1 to 2% higher, largely because of the negative amortization perspective. However, if the loan is at an incredibly low LTV, there may not be much difference in the pricing, but anticipate slightly higher rate on these deferred interest rate loans because the loan to value, assuming the market is flat, is going to be increasing. So with that, investors are taking on a perceived higher risk with a higher loan to value. Last important thing to share with your clients is that while there are no payments, the interest is accumulating. These particular loans do have a compounding effect on the interest. So you can't just say, well, there's 12 months of interest, so just add 12 months of payments on there. The payment does compound, so it is more costly for the borrower. That doesn't take away the benefits of a deferred interest rate loan, but that would be important to share with the borrower. So that's pretty much it on the loan structuring. Next slide. I think we've pretty much covered
Yeah,
everything.
I believe it's more Q&A now, which there's a couple questions here, so I can go through those.
Yeah, I'll let Jeff take over from here.
Yeah, so a couple of the Q&As for us here. So will you lend on a non-warrantable condo? The answer is yes. The loan to value might go down a little bit. The deferred interest program, likely not, Chris, right? I mean, you're not seeing us non-warrantable depending on the LTV,
I
I
don't
guess.
have any issue with that, no.
So it just depends on the loan to value, whether or not we'll do it on the deferred interest deals, but those are definitely an option, and non-warrantable is yes. Let's see here. Will this work as a second if the first is a VA loan? I don't see any issues with that. Chris, do you?
The only time I wouldn't do a second is going to be behind an equity share.
Correct.
If it's an
Yeah, so
equity share loan, we're likely not going to offer this product. Any other existing first, we're going to offer it. Keep in mind, we don't typically go behind private money loans. There are exceptions when they're a long-term private money loan, most commonly seen when it's a seller carryback, but we don't typically originate loans behind other private money lenders with any of our loan products.
okay. Is the deferred product good for owner-occ business purpose as well as investment properties? Yes, for us, the occupancy is not a major factor other than what the purpose of the loan is. So our main concern is what are you using the funds for, business or investment reasons. The occupancy is not as much of a factor for us. So that is fine, regardless of the occupancy. How long is the prepay penalty? That depends on the deal and how you price it in the beginning. We can do as short as no prepay. We just need to know from the beginning so we can price it appropriately for you. Our average prepay penalty is for the first 6 months of the loan. However, like I said, that's negotiable when you're pricing the loan out, so we can make it work for your client on each individual scenario. Let's see here. Will this meeting be recorded? Yes, it will, and you'll receive a copy of it after the fact. This product, is it going to be California only? So in the beginning, it is California only. We are working on the out-of-state compliance questions right now. So as of right now, it's California only. I imagine in the next couple days, we'll know whether or not we can do these in the other states we lend in. My gut feeling is that we can. I'm not running into any major blocks, so we should be okay to do it in the other states that we lend in as well. Let's see, next one. If this is a 2-year product, are all payments deferred for the entire 24 months? Yeah, Chris mentioned that. Basically, these aren't, when we were talking about this product, we wanted to make it clear these are not what you used to call pick and pay loans. You take the loan out, you have the cash. When the first payment you make is going to be the full payment. So whether you're 9 months down the road and you're ready to pay it off, or you want to wait till maturity, any payment needs to be for the entire amount that's due, along with any interest owed.
Yeah, so you can pay the loan off on this product just like you can any other product. When you're ready to pay it off, you pay it off. There's no partial payments, is what we're saying. A borrower can't decide, well, I want to start sending in $1,000 a month or $5,000 a month. No, we don't do that. It's a full payoff or no payoff.
Chris, are there any minimum credit scores in this loan product?
There are none. We're gonna when you push for the higher loan to value, and for us that'll be around 55%. Credit and the condition of the property may have some bearing. We're going to be a little less inclined to go at 55% with somebody with credit scores in the 400s who is showing no pride of ownership in their property than we will with somebody with a higher credit score who takes care of their property. All of these loans, while Jeff and I, we do fund it with our own company money, we do sell these off to private investors down the road. Curb appeal is important to them. Pride of ownership. It's not so much what city it's located in, it's whether or not the owner takes care of their property. That we find that historically speaking, people who take care of their properties are more inclined to continue to take care of their properties and want to keep their property. So there's no minimum credit score, however. And if the loan to value is overwhelmingly low, we'll offer this product to somebody, even with scores in the 4s or low 5s.
Thank you. If it was a 2-year loan, could they defer for 1 year, then make payments for the second year? No, they would need to defer until they pay off the loan. So whether it's the full 2 years or until they're ready to pay it off. Can you do a second mortgage?
I would add in there,
Yeah.
there's always something, if they want to come back and ask for a loan modification after 1 year, for instance, they can always ask, we can consider it Typically, there would be a fee though, so keep that in mind if they do that. So there, in some cases, it might be better for them just to get a whole new loan at that point.
Can you explain what you mean when you say coming back for a loan modification, Chris? So if they come
Well,
back
let's
after
like
1 year of
I
a
think in
2-year
that
loan,
in that question, you wrote a 2-year deferred loan, and at
correct?
the end of 12 months, the borrower came back to their broker and said, "Hey, you know what? I don't want to see the interest grow anymore. I'd like to start making payments on the loan." Well, the borrower's got two options at that point. With this product, more than likely the prepayment penalty has expired, so there's no reason why they couldn't go out and just refinance into a new loan. That would be the first choice. The upside for the broker is he's going to get a new broker fee, and possibly the borrower might want some additional cash out for other business or investment purposes. So that would be the ideal purpose. If all they want to do is start making payments on the loan, they can always reach out to us and ask whether or not the investors, the owners of the loan, would consider a loan modification. In that case, if they would, we typically charge a fee for doing that, that the borrower would have to pay. And if the new owners of the loan say, okay, let's figure out what the unpaid balance is at this point in time, we might be able to modify the loan. We'll have to wait and see whether or not that's something a borrower may want to do, but we certainly would suggest if they want to be able to start making payments on the loan after 1 year that you push them towards a refinance.
Good, thank you. Can you do a second mortgage behind a reverse mortgage?
Oh,
Yeah, I mean, I just did one personally. So I haven't, however, I have not done a deferred interest loan behind a reverse mortgage. So that would be a judgment call. I think we'd have to look at that individual scenario and make a determination if we wanted to do it. Um, I don't think there's a direct answer for that. It depends on the terms of the loan, frankly.
getting back to the loan to value, getting back to the quality of the borrower, and getting back
Yeah.
to the quality of the product. That's certainly possible, but you're going to keep in mind that when Jeff and I look at it, now we have two loans where the balance is growing each month. So we have to take that into consideration when making a decision.
Yeah, and keep in mind if there's a reverse in senior and we're going behind it, I'm gonna look at the term of the loan and I'm gonna basically look at the amortization chart to see what the balance will be at our maturity. And that's usually how we've determined whether or not we'll do a second behind a reverse mortgage. It adds a little more hair, obviously, if we're deferring our payments too, because then that amount, as Chris mentioned with the amortization, goes up greater to a greater amount. So it's got to be a pretty low loan to value with a pretty solid borrower for us to make that determination. Can the funds be used for international investments? Yes. I mean, assuming the funds go into a business account and that's where the money is going to be used, then we're fine with that. It's all about the situation itself. So the answer in short is yes. Please explain the business purpose in more detail. If they're fixing up the property, but occupying is owner occupied, is that a business purpose? No, not if it's owner occupied, because then you're upgrading essentially your primary residence, which is considered consumer. Now, if that's only a small portion of the loan, so if you're taking out a loan for $300,000 and 100 is being used to upgrade your primary and say 20 or 30 is being used for closing costs, and then you got 170 being used to invest in their business, going to the business account, things like that, then technically, yes. As Chris mentioned earlier, the main thing here is what a majority of the funds are being used for. Assuming at least 51% of the loan proceeds are being used for business reasons, then the rest of it can be used for other various needs that the borrower might have.
And let me jump in there. It's not the loan proceeds, 51% of the gross loan amount. So if the loan amount is 100,000, we want to see 51,000 going into the business account or going for the business or investment purpose.
Yeah, exactly. Thank you. How much does this increase the yield? So this is from an investor perspective, it sounds like. How much does this increase the yield since it is a negative amortization? I don't think there's an exact number to that,
That's
depending on
gonna
the
that's
return.
gonna depend on, I mean, it's gonna depend on how long the loan is, whether
Correct.
it's, whether the borrower keeps it for 1 month or whether the borrower keeps it for 24 months. We haven't looked at the amortization schedule to look at what the APR would be to the investor's perspective. Um, when the time comes, we'll be able to share that with both the borrower, and it'll be shared with any potential investors who buy loans from us. But we haven't sat down and calculated it, but we know that this loan will, because every month the interest is being added onto the principal balance and it's being recast at the unpaid balance at the end of each month. It's gonna end up being a higher return to any investor who buys a loan like this, and it's gonna be a higher cost to the borrower.
Okay, next question. Can you pay off the deferred loan with another deferred loan?
I
So
don't see why not.
I don't,
Yeah.
yeah, I don't see why not either. Assuming the loan to value makes sense and assuming it's still a nice deal, I don't see an issue with that.
Yeah.
If a borrower owns two properties, how does the LTV work in this case? Do you do deferred interest loan in this situation, or or is it more like a bridge loan? Property.
Well, I'll jump into that one. I don't, when you say they own two properties, again, if we're securing both properties, are we securing just one property? What is the money being used for? If it's, I mean, for us, again, a bridge loan is when your client comes to you and they say, hey, I own my house, I'm trying to sell it, but I've got another home I want to move into. It's a consumer purpose loan. That's what we look at as a true bridge loan. When they say that, um, then our loan will be secured by the home they own right now, unless there's not enough equity in that property to give them the money they need to buy the new purchase. If they need a bigger loan than we're willing to do on the one property, we would cross both properties. But this is a perfect example as to when a deferred loan might be a benefit. And it can be secured by one property or both properties. Because we know that the borrower's method of repayment is going to be the sale of their existing home. The ability of not having to make payments on this bridge loan would be ideal for them. And again, it'll depend on how much they need as to whether it's secured by one property or both. If that didn't answer your question, send it again and Jeff will jump in on it.
Yeah, and just a note too, when you're doing a true bridge loan, you do have to follow some of the regular consumer guidelines. So there are no prepay penalties. The hard costs are paid out of pocket. They have to get the counseling, blanket on the name, but those are a little bit different and they're have a little more to them. So yeah, but email those over if you have anything you want to discuss more than that. Will you do a first behind an owner carry on a purchase? First behind an owner carry on a
Well, we
purchase.
wouldn't be behind if it's a first.
If
I
it's a
mean,
first, yeah, then yeah, we wouldn't be behind. But
but
sorry.
we're okay with an owner carry. If you come to us with somebody who's buying a $500,000 house and they want a first for 250,000 and they want a deferred interest loan from us and it's an investment property and the seller is going to carry back part of that $250,000 remaining of the purchase price, we're not going to have any objection. Of course, the seller who's carrying back that loan, they may want to see a copy of the note and it will be disclosed that our loan has deferred interest. Whether or not that has any bearing on their decision is really up to them.
Yep, thank you. Are there any usury issues with the bridge loan on owner occupied?
No. Again, if the usury doesn't come into play when the loan is originated by a licensed real estate broker, whether it's secured by owner or non-owner occupied. In California, we have an exclusion from usury laws because we are licensed in the state of California. So whether
Yep.
it's secured by owner or non-owner doesn't matter.
Okay, next one. That reverse mortgage question was more for the regular second mortgage, but that is great. You can consider the deferred. That reverse mortgage question was more for the regular second mortgage question mark. Uh, Go ahead and email me on that one. I'm not quite understanding your question. The
Or
next one,
maybe we answered it.
yeah, the next one just says sounds like cross collateral. Okay.
Yeah, I mean, cross collateral, again, we see that oftentimes in bridge loans. We have cases where, again, somebody owns $1 million house, but they have a $200,000 mortgage on it, but they want to buy $1.5 million home. And they were counting on all of the equity from the sale of their home to be able to do that. But they don't have the equity out of their property. We're not going to loan them $1.5 million on their existing home because it's only worth $1 million. Now we will loan $1.5 million if we can cross both properties. And then they can, from the sale of their property, they can pay our loan down and possibly allow you to refinance and pay off the existing unpaid balance when they do that.
So the next one, I'm going to kind of paraphrase here, but basically it comes to the question of whether or not you can, it looks like cross collateralize two properties where one is owner occupied and one is an investment. You can, but again, the majority of the funds still need to be used for business or investment reasons since one of them is considered owner occupied. But yes, we can do that.
And by the way, too, we don't call it a bridge loan if somebody wants to pull money out of their house to buy an investment property. We don't consider that a bridge loan. We use the word bridge to specifically define a consumer uh, purpose loan where they're buying a new primary residence. Any other loan is just a cash out loan to buy an investment property. We don't call it a bridge loan, whether it's a 6-month loan or a 1-year loan or a 3-year loan.
Yeah, people will often use the term bridge just for short-term financing, and that's not always the case. So, can you do a bridge loan tying up two properties if they are in a different county?
The answer is yes.
If there is a
We've never
sorry,
done one in 2 different states, but 2 different counties, we've done that.
yeah. If there is a lien or loan for solar on the property, will you require it to be paid off in order to do a cash out refinance?
The answer is no.
Yeah,
We do not.
it depends on the lien itself too. If it's just on the equipment, no. If somehow they've put a lien on title that affects the actual property, then that's a different story. But again, we have to just look at it case by case. We can look at the prelim and look at the
Yeah.
UCC that was filed.
Yeah, most commonly it's just secured by the equipment, and in that particular case, we don't require it to be paid off.
Correct. Next person looks like just a comment. I don't think most reverse lenders allow a subordinate lien. I mean, it makes sense as to why that could be the case, but it's also probably a case by case situation depending on the note that was given on the first.
But we will, if they want to get a second behind our deferred interest first, we will allow that. We have no objections to that.
Let's see, the original question, can you do a second mortgage, not a deferred loan, behind a reverse mortgage? The answer is yes. We've done them before. It depends on the deal. It's really a case by case. Just send it in. We can tell you yes or no. Looks like that's all the questions for today. So if you have any other specific questions, go ahead and reach out to us and we can take a look at each one. I think I wanted to comment. I was talking to someone yesterday, a broker of mine, saying, what are you guys good at? I think what we're good at is kind of looking at the deal and coming up with something that makes sense for you. A lot of lending, whether you're looking at DSCR or conventional, it's very much in a grid and kind of in a box. And if it doesn't fit that grid or meet those guidelines, the deal's dead. You don't get paid. You lose that client. In those situations, that's where we come into play. Send us what you have. Let us take a look at it. We can get pretty creative. We can look at different options, whether it's crossing, whether it's doing different things to make it work for your client. That gets you paid now. And then obviously when you take our loan out in the future, maybe you have to wait 6 months to do so or whatever it is, you get paid again, you keep that client and everyone's happy. So I'll leave it with that. Chris, do you have any other comments before we let them go?
Just a real quick one. You'll see my contact information and Jeff's contact information at the bottom of this slide. As Jeff said, we will be making this particular presentation available to everyone. If you have any other associates you want to share it with, be our guest to share it. If you prefer to send Jeff an email and have Jeff send it directly to them, go ahead and do that. And if you're not working directly with myself or Jeff, but you're working with another account executive in our office, send all of your inquiries to them. They will then immediately send it to Jeff or myself for pricing. And on behalf of myself and Jeff and everybody else here at Val-Chris Investments, we greatly appreciate your support and your attendance today. And one last thing, Jeff and I will be setting up most likely monthly seminars, and we're going to go over different little short seminars talking more about our products and what else we're doing, likely starting next month. So expect an invitation for the next presentation in a few weeks.
Yep. And then it looks like one last question has popped in. Do we do thirds in California? The answer is yes, we do thirds in California. So if you got a first and second place, call us on a third and we can tell you if we can make it work. Thank you, everyone. I appreciate your time and thank you for joining us. And hopefully we'll see you at our next one next month.
All right. Thanks, everybody.
Bye-bye.